Good afternoon, everyone. David Blain here, CEO of Blue Sky Wealth Advisors, and welcome to February 2021. I don't know about you, but it seems like just the other day we were getting ready to welcome 2021, and it's February already. I tell you, time just seems to go by pretty quick. Today, we're going to talk about one of my favorite subjects. Actually, I love all the topics that I deal with every day: investments, tax, estate, business planning, all those type of things. But taxes seem to permeate just about every area of our life today. And it's one of the things I really enjoy studying. It's like a big game, and winning the tax game is certainly very important. There's a lot of black and white areas in the tax code, and learning how to use those to your advantage is certainly an advantage in life, and an advantage in your finances. So we're going to spend some time today talking about that. I am going to do some separate videos specifically on retirement planning. There are a number of proposed changes by the new administration for retirement planning, estate planning, as well as real estate that kind of bleed over into the tax arena. But today, I'm gonna leave those for another day and focus strictly on the sort of income tax aspects of the new administration's proposals. And that's the first thing I want to start off with. Is just about everything I say today is a proposal. There's nothing definite as of right now going on with the taxes. As you know, there's split government right now, House and Senate and the presidency. While it appears Democrats have control by virtue of the vice president, the reality is it may be difficult to jam some of this stuff through Congress. So just keep that in mind. Everything I talk about today is in fact proposed based on the Biden campaign documents, things that he said on the campaign trail, things that are actually printed on various Biden websites, as well as some comments and writings of key political appointees and cabinet members, including some career politicians. Richard Neal from Massachusetts, who's now chair of the House Ways and Means Committee, which is who sets tax policy in the House, as well as the Senate Finance Committee Chairman Ron Wyden from Oregon, who takes care of that sort of stuff in the Senate. So just knowing what those folks have said in the past and what has been printed, I've gone through the various proposals, and we'll talk about A, what they are, B, is there something you need to do from a tax planning perspective today, or just maybe to be on the lookout for. Before we get into that, one other thing I want to talk about is I get a lot of questions about retroactive changes to the tax law. People have said, well, could these changes be effective January 1, 2021? And the short answer is yes. There is precedent for that. In fact, back in 1993, the Omnibus Budget Reconciliation Act of 1993 was retroactive. There's some other things that have been retroactive, and the Supreme Court has actually weighed in on the legality of retroactive tax changes, and they have upheld some tax changes to existing tax laws that made them retroactive. Now, I will say it's somewhat uncommon to enact a brand new law that is retroactive. That typically it's going to be tweaks to an existing law. From a political standpoint, some of these changes are very difficult to do. When someone's managed their affairs, set things up already in the year, to change them midstream generally is not a great idea. But the answer to the question is yes, it's legal. It could be possible. I think not likely that some of these significant things take place immediately. So we should have a fair amount of time, the remainder of this year, to plan for them. Of course, if it is retroactive, depending on whatever date that is passed, we'd still have the remainder of the year, assumably, to make some changes. I don't know if you recall, there was a point, there was 3 capital gains rates. There was the prior capital gains, there was a long-term rate, and then there was a capital gains rate. Like when you did taxes, you had to split your capital gains between I don't know, January and August or something, and then August and the end of the year. They literally changed it in the middle of the year and made it effective as of some date. So we should have a better read on that once the administration gets up and running, get some more appointees, get some more executive orders signed or whatever they're doing, before we get into some meaningful. We got another impeachment. So they got a lot of things to get to before they get to the tax law. But once they do, we'll certainly update you with what looks like it's going to go through or not. But what I want to do today is make sure that you're well prepared ahead of time, that if you're doing this yourself, you can think about it yourself. If you work with our teams of advisors, that you can start talking about these things. Essentially, the summary, if I could summarize it in one thing, is that the theme of the Biden administration and some of these people is that if you make over $400,000 a year, they're coming to get you. Your taxes are going up if you make over $400,000 a year. Targeting the sort of evil millionaire, billionaire type thing. Everybody pay their fair share. I mean, you've heard all the rhetoric, but essentially when it comes down to it, anyone that makes over $400,000 a year is the main target of this. Although I have to say, and I'll point out some examples where some of these things do trickle down inadvertently to people making less than that. There's some really disastrous ones, especially in the estate planning and some of the other arenas that we'll talk about. But essentially, most of the things are targeted at people that make over $400,000 a year. So number one, I want to talk about is the Social Security tax. So right now, if you are a worker, if you work someplace, you pay Social Security tax, which is 6.2% you pay and 6.2% your employer pays in 2021 up to the first $142,800 of income. Anything above that, there's no Social Security tax. There is Medicare tax, but no Social Security tax. So under the Biden administration proposal, anyone that makes over $400,000 a year will in fact have this 12.4% Social Security tax on anything $401,000 and above, unlimited, split equally between the employer and the employee. This creates somewhat of a donut hole, if you will, to borrow a phrase from the Medicare Part D prescription drug coverage. It has a donut hole between that $142,800 limit of today and $400,000. There would be no extra Social Security tax due. And so there's huge planning opportunities there for those that have some control over their ability to control their income. Obviously, you want to keep that income below $400,000. Of course, from the employer's perspective as well, tacking on another 6.2% to those high earners. A lot of companies is not going to matter, but some of your bigger companies, your high tech, things like that, that have quite a few people above that level, it certainly would have an impact on them. But I think you'll see a flurry of tax planning for people in those arenas to keep that below that. Because when you look at the tax rates, which is the next thing we're talking about, the highest marginal rate going up on people make above $400,000 to 39.6, plus you add in another 6.2% for the employee on their wages. If they're a business owner, of course, they bear the full brunt of that 12.4%. Once again, you're getting well into the 50, 60% range when you factor in federal, state, Social Security, Medicare taxes, especially on a self-employed person. You're really getting into some serious high percentage of their income that they pay. And so you'll see a lot of aggressive tactics to keep that income below $400,000. And I know that for those of you that are in that arena, we'll certainly stand by you and come up with those strategies to help with that. But the next big proposal is in fact eliminating the 37% bracket as the highest bracket and raising that to 39.6%. It's a little bit unclear in the proposals whether this would be the household or there would be a different rate for single people, but regardless, they would eliminate the Tax Cut and Jobs Act maximum rate of 37% and go back to 39.6%. One of these days when I have time, I'd love to go back in the congressional record and see how they came up with 39.6%. A lot of this stuff, of course, is some compromise between people but I'm kind of a round number person when it comes to something like that. It's just such a false sense of precision. 39.6% implies that someone actually calculated that, and the reality is probably the result of some compromise between people. But anyway, so right now the current maximum bracket starts at $518,000 for a single person and $622,000 for couples. So bringing that up to 39.6%, you're going to see some single people in the 35% bracket and 37% bracket go into the 39.6. And for married couples, some people that make over 400,000 are in the 32% bracket. So you're going to see their ordinary income bracket, go up by 7.6% plus another 6.2% Social Security, Medicare. It can be really punitive if you're just over that $400,000 threshold. Now, if someone's making, $5 million already, they're already in those higher tax brackets. But certainly for someone that's right around that threshold, the marginal effect of these tax rates will be huge. And we see that also with some of the healthcare subsidies is when you have something like that and you hit like a dollar threshold and the tax leaps up, you see that even an additional dollar of income can make a huge amount of a difference. So what's the strategy here? Obviously, if you are in that arena, as I said, if you're close to that and it looks like these rates will go up, what you want to do is accelerate that income into the year or time period when it's lower, especially if you're in the higher brackets already, if you're in the highest bracket already, you're already paying 37%, there's really no downside risk to accelerating your income to hedge against rising income tax rates. Now, if you're down in that 32% or 35% level and we're not sure if tax rates are going to go up and you intentionally accelerate into the 37% bracket today, there is some risk that if the rules don't pass and the rates do not go up, you will have paid more tax than necessary. So we want to be careful about that, accelerating too much. But if you're already over and well into the highest bracket, there's no downside at all to accelerating income into these lower or potentially lower tax brackets. Now, what are some techniques that you can do to accelerate your income? One of my favorite ones is Roth conversions. Take some of that money out of that pre-tax retirement account, that 401k, that deductible IRA, and go ahead and do a Roth conversion. If you're trying to accelerate income, that's one of my favorite techniques to use. Go ahead and get it out of that tax-deferred account and get it into a tax-free account with Roth conversions. Of course, business owners that have a little bit more control of their income can accelerate that income, as well as people that work for public companies and have any type of stock option. Now, of course, the investment thesis needs to outweigh the acceleration of income, but if you have a chance and it makes sense from an investment standpoint, go ahead and accelerate the exercise of some of those options into an earlier year to hedge against those rising rates. Okay, the third area I want to talk about is capital gains as well as qualified dividends. So now capital gains and dividends, what we call qualified dividends, which are essentially most dividends paid by U.S. domestic companies, are subject to a favorable tax rate of 20% plus possibly a 3.8% additional Medicare tax. Now, people in the lowest tax brackets pay 0% capital gain and 0% on their dividends, but right now the maximum rate is 20%. Under the Biden administration proposals, we see that they want to raise it on people that have over $1 million of income, raise it to the ordinary income rate of 39.6%. So this is the one thing that you see is not currently targeted to people at the 400,000 and above, but it's people at $1 million and above that would tax that capital gain at ordinary income rate. Once again, if you look at this and you take that 39.6 plus the 3.8% Medicare tax, which is not proposed to go away, now you're looking at a capital gains rate of 43.4%. You take that same person, assuming they live in, if they live in California or something like that, and they make over $1 million a year, you're talking about a capital gains rate in excess of 50%. So they really have to do some planning there if you're in that boat. Of course, you can accelerate those capital gains to today, where that rate is a maximum of 20 plus the 3.8, so a maximum of 23.8%. You may want to accelerate it. Once again, if you're already in the top bracket, no harm, no foul. You might as well go ahead and do it. You have nothing really to lose. If you're not, though, there are a couple options you can do. Number one is don't sell. You're not going to incur the additional capital gains tax if you don't sell. So continue to exercise that buy and hold strategy. Number two would be invest in more growth and less dividend paying stocks. Once again, getting your dividends taxed at greater than 50% is really no fun. When the dividend yield is, maybe 2% max, and you're losing 1% of that to tax, you may want to relook at investing in high dividend payers. You're just losing a lot of that to taxation. Of course, income splitting will be huge, gifting some of that stock to children or something and let them sell it and pay the tax. Of course, you got to watch out for the kiddie tax rules there, but certainly if you have adult children, this is going to be a great strategy. Income splitting, gifting some of that stock to them or to charity. Giving appreciated securities to charity, if you're in the 50% plus capital gains rate, will be huge. You definitely want to exercise that strategy. Also, installment sales. If you sell a piece of real estate or something like that that's subject to installment sale treatment, you can spread that tax out over a number of years and hopefully stay below that $1 million threshold each year. Also, if this does come to pass, what we'll probably want to do for people that have to take capital gains during their lifetime and have like a budget each year is obviously we want to make sure that they're harvesting those capital gains and they're keeping below that $1 million threshold. Now, we're not going to go into it completely today, but kind of hand in hand with this capital gains issue is another one of the proposals. There'll be no step up in basis on someone's death. And well, what does that mean? It means right now when someone dies, the embedded capital gains, the unrealized gains are essentially wiped away. Under the Biden administration proposal that's out there right now, that would not be the case and the tax would become immediately due. So we're going to see a lot of change in thinking on the way that we handle capital gains in our investments if these things do come to pass.